Meta Platforms is considering to lay off up to 20% of their staff as they desperately seek to offset AI investments. The news came out after they reported record revenues of $60 billion in Q4 2025, up 24% year over year. So how is it that the company is down 24% from their high in 2025? Well, the company now expects to spend $135 billion in AI capex in 2026, which is essentially 100% of their free cash flow in the same fiscal year. But okay, a seasoned investor would think that they're spending all of this money because they will see a big return in the future, right? So why is the market punishing them for investing in the future? And to answer that question, we'll look at the company's performance the last few years and then rationalize the capital expenditures and their price action. Let's go back in time to 2018, a time when Facebook was getting sued to oblivion by everyone and their mom. They even got hit with the highest ever settlement by the FTC, a $5 billion penalty. A few years later, the company decided it was time for a new beginning and rebranded from Facebook to Meta Platforms. Somehow, the rebranding actually worked, and at this point, most of their legal issues and the negative press had subsided, and the company was fresh off to new highs. But the perfect storm was bubbling up in the sea. TikTok competition, Apple iOS privacy changes, and the bear market came along. However, more importantly, this is when Meta started investing in the metaverse. And by 2022, the company had already lost $14 billion in their new venture, while at the same time, the company lost 75% of their value. And in November 2022, Meta hit rock bottom. And this is when they began the so-called Year of Efficiency. Now, fast forward to today, the company has rallied 500% from the 2022 bottom, but the ridiculousness of the metaverse created a lot of trust issues that linger with the current management. So all of this begs the question, is it different this time? After $70 billion in losses, have they learned the lesson? Is the increase in capital expenditures really justified? Not only they are hiring people for $200 million, but the dollar amount in revenue growth equals the gain in operating expenses, which means that they do not have increased operating leverage, something that investors do not like. And the market is voting that this remains the biggest question mark for Meta in 2026. And now the last thing to consider is that technical analysis on Meta's stock is really not giving a lot of positive signals, particularly because we are below both the 50-day moving average and the 200-day moving average. We also have a mini head and shoulders here, which is usually not a good sign. So as a conclusion, unless management reduces or signals that they will spend less in capital expenditures, or they start showing substantial direct evidence of benefits from their investments, I personally believe that it's more likely that the stock goes down to the 480 level than it going back up without a real catalyst. But listen, the jury's still out. This has been a lot of negative commentary. While I do believe it's more likely the stock goes down in the short term, I think long term, this is a $1,000 stock 2-3 years out in the future. So there you go, guys. That's all I had today. I hope you liked the video. Thank you for your time.